Welcome to the Technicals Masterclass. In this video, we will explore the indicators that actually matter, why they matter, and how to effectively stack them to build a robust strategy without falling into the common traps that lead to failure. Before we begin, it is important to state that everything in this video is for educational purposes only. This is not financial advice, a signal service, or a recommendation. Markets involve significant risk, and it is crucial to do your own research and manage your risk carefully. Meet Backtest Brad, your anti-mentor. Brad believes charts are just astrology and blames technical analysis when his impulsive, unresearched trades fail. We will use Brad's mistakes throughout this series to teach you exactly what not to do. This masterclass is built as a catalog, designed to be visual first. We focus on why indicators matter, how to use them, and crucially, how to avoid common pitfalls. We emphasize that no single indicator is magic. True edge comes from confluence and context. Think of trading like a three-legged stool: macro, fundamentals, and technicals. This video series focuses on the technical leg, your entries, exits, and risk management. But remember, the best setups happen when all three legs are in agreement. Technical analysis is not about predicting the future. It is the study of price and volume to identify where the odds tilt in your favor. It provides a framework to organize your decisions amidst the uncertainty of the market. Always remember this first principle: price is the only thing that pays you. All indicators are derived from price. They are useful advisors for context, but they are never the boss. If an indicator disagrees with price, price wins. Every chart you see is built from candlesticks. Each candle represents the battle between buyers and sellers over a set period. By reading bodies and wicks, you can identify conviction, indecision, and areas where price is being rejected. Before applying any indicator, learn to read raw candles. Shapes like the Marubozu indicate strong conviction, while hammers or dojis often signal potential rejections or indecision. Always remember that the context, or where the candle appears, is more important than the shape itself. Time frame is arguably the most important and underappreciated concept in technicals. The same indicator value means something very different on a 1-minute chart compared to a monthly chart. Always choose the time frame that aligns with your specific trading intent. A pattern on a 1-minute chart is not the same as that same pattern on a monthly chart. The 1-minute chart is often driven by market microstructure and noise, while the monthly chart reflects real money positioning and structural trends. Gravity is much heavier on higher time frames. Markets are fractal, meaning they look similar at different zoom levels. While this is beautiful, it is also a trap. Just because a pattern appears on a 5-minute chart, it does not mean it has the same reliability as it does on a daily time frame. Follow a top-down workflow. Start with a higher time frame to set your bias and identify the tide. Then, use lower time frames for precise execution. If your time frames conflict, the probability of a successful trade drops significantly. Trade smaller or stay on the sidelines. Now let's begin section 1, moving averages. We'll cover the basics of simple and exponential moving averages, how to use them to identify trends, and how to avoid the common mistakes people make with moving average crosses. The simple moving average, or SMA, is the foundation of many indicators. It smooths out price data to help you identify the trend. Remember, it is a lagging indicator. It tells you what the trend was, not what it will be. Use it to gauge bias, not to predict news. Next is the exponential moving average, or EMA. It is the SMA's faster cousin, giving more weight to recent price action. This allows it to hug the price closer, helping you spot trend shifts and dynamic support or resistance faster than an SMA could. The 9 EMA acts as the heartbeat of momentum. It is a highly reactive, short-term guide. In a strong trend, you will see price riding the 9 EMA. Use it to gauge immediate momentum, but remember, it is a trigger, not a long-term thesis. The 21 EMA is the workhorse of the trio. It serves as your "is this pullback still healthy" gauge. When pullbacks bottom out near the 21 EMA in an uptrend, it suggests the swing momentum remains intact. A decisive close below this level should alert you to a potential shift in bias. The 55 EMA acts as the slow anchor for the stack. It is derived from a Fibonacci number and provides a filter for the dominant trend on your chosen time frame. When price holds above a rising 55, you are on the right side of the regime. Don't read these 3 lines in isolation. Read them as a single ribbon. Fanned out means a strong, healthy trend. Compressed lines suggest the market is balancing. Crosses between the 9 and 21 provide an early heads-up for momentum shifts, while gaps indicate when price is extended. Big money institutions pay close attention to the 50, 100, and 200 SMA on daily charts. These aren't just lines, they are battle lines. Reclaiming or losing the 200 SMA is considered a major structural event, often becoming a self-fulfilling prophecy for the broader market. Golden and death crosses are the most famous and overhyped signals. A golden cross, 50 SMA over 200 SMA, confirms a long-term bull trend, and a death cross signals the opposite. Use them for big-picture regime context, but never use them as a blind, standalone entry signal. The weighted moving average, or WMA, provides a middle ground. It is faster than an SMA, but avoids the exponential tail of an EMA. It is a tool for those who want a bit more responsiveness in their trend filters without the extreme sensitivity of faster averages. The whole moving average, or HMA, is engineered to be both fast and smooth. It does a great job of cutting through lag, helping you see turn signals faster. However, keep in mind that its speed comes at the cost of being more susceptible to false signals in sideways markets. DEMA and TEMA, double and triple exponential moving averages, are mathematically designed to subtract lag. By combining multiple EMA layers, they track price very closely. They are powerful for trend following, but like any fast tool, they will whipsaw you in a non-trending, choppy environment. The volume-weighted moving average, or VWMA, introduces volume into the calculation. It prioritizes price action that occurs on higher volume. Comparing a VWMA to a standard SMA is an excellent way to see if a price move has true conviction, or if it is merely low-volume drifting. Use moving averages as dynamic support and resistance. In an uptrend, they act as a floor. In a downtrend, a ceiling. The first touch after a breakout is usually the most reliable. Combine these touches with horizontal levels for high confluence entry setups. Finally, respect the lag. A moving average crossover is, by definition, a trailing indicator. You are paying a lag tax to confirm the trend. Don't fight the tax. Just ensure you are only taking these signals when they align with the broader market trend. Even Backtest Brad eventually learned that cluttering your screen with 6 different moving averages doesn't make you a better trader. It just creates a mess. Stick to a simple, clean stack. Use the right tools on the right time frame, and stop looking for the magic indicator. In the next section, we move beyond time-based averages to explore volume-based analysis, specifically VWAP and anchored VWAP. These are essential tools for understanding institutional fair value. I will see you in Section 2. Welcome to Section 2. We are moving from time-based averages to volume-based ones, starting with VWAP. The volume-weighted average price, or VWAP, is the benchmark institutions use to grade their fills. It is not just a line, it is a vital reference for daily fair value. VWAP standard deviation bands are a volatility envelope around the mean. They help you gauge how stretched price is from fair value. In range-bound markets, they are great for fading extremes, but in strong trends, they can act as dynamic support or resistance. The anchored VWAP, or AVWAP, is perhaps the most powerful tool in this masterclass. By anchoring the calculation to a specific event, like an earnings gap or a major pivot, you get a precise, story-driven support or resistance line that reflects the cost basis of those events. Your AVWAP is only as good as your anchor. Focus on pivots that matter: earnings gaps, major swing highs or lows, the yearly open, or significant news catalysts. If you anchor to a random candle, you are just drawing lines for the sake of vibes. VWAP becomes truly dangerous when you use it for confluence. When session VWAP, a key AVWAP, and a Fibonacci level all converge in one area, that price zone is heavily defended by market participants. That is where high-probability setups are born. Welcome to Section 3, Momentum Oscillators. These tools help you measure the speed and intensity of price action. We will cover the RSI, stochastics, and MACD, not as standalone triggers, but as gauges to confirm what price is already telling you. The Relative Strength Index, or RSI, is the most popular oscillator. It scales price momentum from 0 to 100. While it identifies overbought and oversold conditions, its true power lies in spotting divergences, where momentum stops confirming price strength. The 70/30ths RSI rule is often a trap. In a powerful trend, RSI can stay overbought for weeks. Buying weakness or selling strength simply because of an RSI number is a common mistake. Context and trend regime always override raw indicator values. RSI divergence is the real edge. When price hits a new high, but RSI makes a lower high, momentum is fading. This is a warning to tighten stops or look for a reversal. It is a signal of exhaustion, but always wait for price structure to confirm. RSI levels are regime dependent. In a strong uptrend, 40 often becomes the new 30. In a deep downtrend, 60 often acts as the new 70. Use the center line, the 50 level, as a filter for your directional bias to keep yourself on the right side of the market. For an RSI playbook, stop trying to find magic levels. Identify the trend, hunt for divergences that establish support or resistance, and use the 50 line as a filter. Most importantly, demand price confirmation. Never trade the oscillator in isolation. Backtest Brad once tried to trade a penny stock with an RSI of 99, thinking that because it couldn't go higher, it must be the safest buy ever. It was actually the most stretched and dangerous trade possible. Don't be the exit liquidity for mathematically misunderstood indicators. Next is the stochastic oscillator. It's faster and more sensitive than the RSI, measuring where the current price sits within its recent range. It is particularly useful for timing turnaround points in range-bound markets, though it remains prone to noise during strong, directional trends. The stochastic RSI takes the sensitivity of stochastics and applies it to the RSI. It is extremely fast, an oscillator of an oscillator. It is helpful for rapid scalping, but fires false signals constantly. Use it to refine your entries, never to form your core thesis. Finally, the MACD. It bridges the gap between momentum and trend following. By watching the convergence and divergence of moving averages and the histogram's pace, you can visually track momentum acceleration. It is a classic for a reason, but remember, it will always lag behind price. The MACD histogram is often underused, yet it acts as a momentum indicator that frequently turns before price. Growing bars indicate accelerating momentum, while shrinking bars suggest a deceleration, warning that a move is tiring. Look for divergences where price hits a new high, but the histogram peaks lower, often signaling a reversal. The Commodity Channel Index, or CCI, measures how far price has deviated from its statistical average. While it's unbounded, the plus or minus 100 levels are your primary action zones. Use it to spot the start of new trends or potential overextensions, keeping in mind that, quote, extreme is always relative to the instrument. Williams %R is a fast momentum gauge that shows where the current close sits within a recent high-low range. Inverted from 0 to minus 100, readings between 0 and minus 20 are considered overbought, while minus 80 to minus 100 are oversold. It's excellent for timing entries within a known trend, but beware of pinning during strong momentum. The rate of change, or ROC, and the standard momentum indicator provide the purest view of speed and price movement. By plotting changes around a zero line, they strip momentum down to its essence. Remember that these are noisy, so they work best as support for your analysis rather than as standalone triggers. The Awesome Oscillator, or AO, visualizes the difference between a 5-period and a 34-period SMA of the bar's midpoint. It's a clean way to see if short-term momentum is outpacing the longer-term trend. Treat it as a styled MACD histogram and look for zero-line crosses and twin peak patterns. The True Strength Index, or TSI, uses double smoothing to filter out noise while remaining responsive. By producing a clearer oscillator with a signal line, it helps reduce the whipsaw effect seen in raw momentum indicators. Use it for standard trend bias and divergence signals, just be mindful of the slight lag. The Ultimate Oscillator aims to fix the flaws of single timeframe indicators by blending 3 distinct periods into one reading. This approach helps produce more robust divergence signals and filters out false alarms. Its primary strength lies in confirmation across those blended periods, making it a sturdier tool in your kit. Trix is a triple-smoothed exponential momentum oscillator designed to ignore minor wiggles. Because it aggressively filters out noise, it excels at isolating the dominant momentum cycle. However, that triple smoothing does introduce lag, so it's best paired with a faster trigger when you're ready to time your entries. ADX and DMI measure trend strength, not direction. A rising ADX indicates a strengthening trend regardless of whether it's up or down. This is crucial for deciding whether to use trend-following tools or range-based strategies. Never mistake a rising ADX for a bullish signal. It only confirms the current move is gaining momentum. Here is a quick look at the oscillator family. From RSI for general trend divergence to stochastic for ranges and ADX for regime filtering, each tool serves a specific purpose. Remember, no oscillator predicts future price action. They only describe the speed of the current move, which you must always confirm with price. Brad's Corner reminds us that divergence is just a warning, not an order. Just because an indicator shows a divergence doesn't mean a reversal is imminent. Strong trends can produce constant divergences while they continue to run. Always wait for price to break structure and provide clear confirmation before acting. Welcome to Section 4, where we cover volume and the volume profile. Volume is the fuel gauge of the market. It reveals who is showing up and at which prices they are placing their bets. Understanding this is key to interpreting the conviction behind any price move. Volume counts how much actually changed hands, revealing the strength behind price action. Price tells you the where, but volume tells you how badly market participants wanted to be there. Thin volume breakouts are often traps, while heavy volume confirms genuine intent and strong market decisions. Volume confirmation is vital for identifying valid trends. When price climbs but volume fades, it's a warning that buyers are losing their ammunition. This divergence is often one of the cleanest signals of a move living on borrowed time. Don't rush to short, but use this as a cue to tighten your risk. On-balance volume, or OBV, turns volume into a running total, adding on up days and subtracting on down days. The raw number is irrelevant. What matters is the slope of the line and its agreement with price. If OBV hits new highs while price fails to do so, you've found a sign of accumulation or distribution. Accumulation and distribution, or AD, improves on OBV by weighting each bar based on where price closed within its range. By determining if buyers or sellers won the session and scaling volume accordingly, it provides a more nuanced view of the underlying flow. Watch for divergences from price as key indicators of potential strength. Chaikin Money Flow, or CMF, effectively packages accumulation and distribution data into a tidy oscillator centered around zero. When it sits above zero, it indicates net buying pressure, while below zero suggests net selling. It's a great way to confirm the side of a move and spot trend bias at a glance. Think of the Money Flow Index as an RSI that drank a volume smoothie. It's a volume-weighted momentum gauge that helps you identify overbought and oversold conditions with more context. Because it accounts for participation, its extremes often carry more weight and produce fewer empty signals than a standard RSI. The Klinger volume oscillator is designed to spot trend turns early by comparing short and long-term volume force. By looking at the force behind volume, rather than just the raw size, it aims to catch reversals that price action alone might hide. Use it with a signal line for cross-based entry alerts. Volume Profile flips the standard volume view on its side, showing how much trading occurred at each price level instead of each unit of time. It reveals which price zones represent battlegrounds of heavy activity and which are just air pockets. It is an essential tool for understanding market auctions. The point of control, or POC, is the single price level with the most volume traded, serving as the market's center of gravity. Price often gravitates toward this level, and it acts as a crucial pivot point. Observing how price behaves when it tests the POC can reveal the market's current intent. The value area, defined by the VAH and VAL, marks the band containing approximately 70% of the volume. Inside this zone, the market has established fair value. When price moves outside this range, it indicates an attempt to establish a new value, often signaling the potential for a trend day. A naked or virgin POC is a previous point of control that price has not yet revisited. These levels often act like unpaid bills. The market has unfinished business there, and there is a statistical tendency for price to return and clear them, making them excellent target or reaction zones. Confluence is where your analysis truly shines. When a volume-based POC aligns with a Fibonacci level, you have two independent methods agreeing on one price. This level is far more powerful than either tool in isolation, creating a robust zone where institutional interest is likely to manifest. Brad's Corner reminds us that volume profile isn't magic. Buying just because price hit a POC is a gamble. You must wait for the level to show a reaction, a bounce, a wick, or a shift in structure. If you mistake the tool for a crystal ball, you'll be the one providing liquidity to the market. Welcome to Section 5, Fibonacci. These ratios, derived from a centuries-old mathematical pattern, appear frequently in market movements. When anchored honestly on valid swing points, they provide a reliable framework for understanding natural price pullbacks and trend continuations, rather than relying on pure guesswork. Fibonacci retracement tools project common levels onto a price move, such as the 0.382 or 0.618, where pullbacks often find support or resistance. They help you gauge the health of a trend. A shallow retracement suggests intense strength, while a deeper one shows the market is catching its breath. While many lines print on the screen, prioritize your focus. The 0.382 shows a strong trend. The 0.618 is the golden standard for pullbacks, and the 0.786 is the last line of defense. Knowing which levels hold significance for the current market regime is more important than memorizing the entire toolset. The golden pocket is the zone between the 0.618 and 0.65 retracement. It is arguably the most coveted real estate on the Fibonacci tool. Many professional traders look to this precise area for high probability entries, as it balances a deep discount on entry with the statistical continuation of the existing trend. Lastly, the 50% retracement. While not a true Fibonacci number, it's the midpoint of every move. Because so many traders use it to decide if a move has hit its half-back point, it becomes a self-fulfilling level of support and resistance that you cannot afford to ignore in your analysis. Now let's move to Fibonacci extensions. While retracements help find your entries, extensions project where the move might land. By measuring the initial push, these levels suggest logical areas for profit-taking beyond the previous high or low, giving you a target-based exit rather than just hope. Extensions like the 1.272, 1.414, and the 1.618 are key to forecasting where a trend might exhaust itself. Once price clears the 100% mark of a prior swing, these levels act as potential turning points. They help transform a simple directional trade into a structured plan with defined objectives. To use these effectively, treat extensions as scale-out zones for taking profits, not as magnets that price is obligated to hit. Let the market structure confirm that it actually respects these levels before you trust them with your entire position. Remember, they define where you want to be, not where you must be. Fibonacci time zones take a different approach by applying ratios to the x-axis. Instead of looking for price levels, we use vertical lines spaced by the Fibonacci sequence to flag windows where trends might change. It shifts your perspective from what price to when, adding a new dimension to your analysis. These time zones provide windows where market activity may cluster, but keep your expectations in check. They are among the fuzziest tools in the kit and should only ever be used to increase your awareness for a potential reaction, never as a precise timing mechanism for orders. For more advanced work, Fibonacci fans and arcs apply geometry to your charts. Fans draw trendline-style rays from a pivot, while arcs provide curved support and resistance. They are specifically useful for accelerating or strongly trending markets, where horizontal levels might fail to keep up with the action. These tools can be dynamic and provide unique sloping support, but they are also very easy to overfit. If you find yourself shifting the anchor points until the math works, you've lost the plot. Anchor once at a clear, significant pivot, and then leave it alone to see if the market respects it. The most important rule for all Fibonacci tools: don't lie to yourself. A tool is only as good as the 2 points you choose to anchor it to. Use obvious, high time frame swings that everyone can see. Using micro-wicks that only you noticed will lead to poor, subjective levels. Ensure your anchors are consistent across every chart. Whether you anchor to the candle body or the wick, stick to one method. If you're constantly sliding your anchors to make the chart fit your current bias, you aren't trading. You're just looking at hindsight and tricking your brain. Finally, prioritize confluence over pure precision. A Fibonacci retracement is just a line on a chart, but a retracement that overlaps a point of control, a VWAP level, or a previous high is an institutional grade zone. That convergence is where you should look to trade, not at single, isolated levels. Brad's Corner is back to address the common mistake: drawing fibs after the fact. If you anchor your fibs only after the reaction has already happened, you're merely coloring in the past. Real analysis requires picking your pivots in advance and accepting that, sometimes, the market will ignore your lines. Moving on to Section 6, Volatility. This section covers the tools that measure the market's heartbeat, how fast and how far it wants to move. This is the difference between a gambler guessing a direction and a trader who understands the range they are working within. Bollinger Bands are the staple here. They plot a moving average surrounded by bands set 2 standard deviations away. They are visually intuitive. They widen when the market gets chaotic and pinch tight when the market is in a lull, providing a clear snapshot of current volatility levels. Remember that a touch of the band is not a trade signal. In strong trends, price can walk the band for long periods. If you treat every touch as a reversal opportunity, you'll be fighting the trend. Use the bands to assess statistical extremes, not to trigger premature counter-trend entries. The Bollinger Squeeze is a specific state of contraction that warns a major move is brewing. While it doesn't tell you the direction, it tells you that energy is coiling. Use this as a warning to be ready, but wait for the actual breakout and momentum confirmation before putting capital at risk. Support and resistance are the foundational elements of technical analysis. Think of these not as precise lines, but as zones of interest, where market sentiment shifts. A key principle is polarity. Broken support often flips to become resistance. The more a level is tested, the more significant it becomes. Always look for confluence with other metrics to confirm your trades. Trend lines provide a dynamic, sloping version of support and resistance. By connecting swing points, you can visualize the slope of a move. These lines are vital for tracking momentum and identifying potential trend changes. Remember, draw your lines based on obvious swings, and avoid the temptation to adjust them just to make them fit a trade. Market structure is defined by higher highs and higher lows in an uptrend, or lower highs and lower lows in a downtrend. This staircase pattern is the most transferable skill in analysis. A break of structure, or BOS, serves as an early warning that the trend's character has shifted. Always keep in mind that market structure is fractal and exists across all timeframes. Pivot points offer an objective, formula-driven approach to support and resistance. Based on the prior period's high, low, and close, they provide pre-marked zones for the session. Many traders use the central pivot as a divider between bullish and bearish sentiment. These levels are valued for their mechanical nature, as they are widely watched across the market. Beyond classic pivots, variations like Camarilla and Fibonacci pivots exist. Camarilla pivots tend to cluster levels closer to price, which can be useful for reversion strategies. Fibonacci pivots use specific ratios for spacing. The best advice is to pick one system and master it, rather than cluttering your chart with too many conflicting indicators. The Ichimoku Cloud is a comprehensive trend system that combines 5 different components into one visual framework. It provides insight into trend, momentum, and support or resistance simultaneously. While it may look complex initially, it excels at providing immediate context. Remember to master the cloud first, before incorporating its more advanced components, like line crosses. The parabolic SAR is a mechanical tool that acts as a trailing stop by printing dots above or below the price. It's designed to flip sides when momentum shifts, providing a clear visual of the current trend. Use it for managing exits in established trends, but be cautious. It can be very ineffective in ranging markets where it will trigger false signals. The Supertrend Indicator is another ATR-based tool that simplifies trends into a binary, color-coded line. It's excellent for maintaining a clear trend bias and disciplined trailing stops. However, like many trend-following indicators, it is prone to whipsaws, frequent, alternating signals, during sideways or choppy market conditions, so consider using a momentum filter alongside it. A linear regression channel uses statistical best-fit modeling to create a trend line with outer rails based on standard deviation. This objectifies your trend channel, removing manual drawing bias. The center line acts as a measure of fair value, while the outer rails represent potential exhaustion points. Be aware that these channels repaint as new data arrives. Elliott wave theory attempts to map market rhythm through repeating patterns of crowd psychology, divided into 5 impulsive waves and 3 corrective waves. While it provides a useful framework for understanding where you are in a cycle, it can be highly subjective. Always use it for context and risk management rather than as a definitive prediction machine. Gann tools are a more esoteric set of methods that attempt to link price and time using geometric ratios. Proponents believe markets move in proportional patterns based on these angles and squares. If you choose to use these, keep it simple and rules-based. It is very easy to overfit these tools, so prioritize objective validation over complex theories. This video highlights the dangers of flexible analysis, like using Elliott wave to justify any outcome retroactively. True analysis requires falsifiability, the ability to be proven wrong. If a framework allows you to interpret every move as a success after the fact, it likely has no predictive or profitable value. Stick to strategies that provide clear, predefined invalidation points. We are moving into chart patterns, the recurring shapes that traders watch to identify potential market moves. It is vital to remember that these patterns are not static. Their significance is heavily dependent on the time frame you are viewing. A pattern that looks meaningful on a monthly chart may be nothing more than noise on a 1-minute chart. Remember that chart patterns are manifestations of psychological battles between buyers and sellers, not mystical signals. Always prioritize confirmation over prediction. Wait for price to break and hold. Volume is a critical piece of evidence for validating a breakout. Finally, ensure your target projection is based on measured moves, providing an objective exit point for your trade. The head and shoulders pattern is a classic reversal formation, showing buyer exhaustion after a failed push. It consists of 3 peaks, with the middle being the highest. The trade is triggered by a break of the neckline, connecting the pattern's lows. Never trade these until the neckline is clearly broken and held, as premature entries can lead to false signals. Next, we explore double tops and double bottoms. These represent 2 failed attempts to break a specific level, showing that the market has tested a wall and given up. A double top signals potential reversal, while a double bottom is its mirror at support. The key here is waiting for the break of the middle pivot to confirm the pattern before acting. Remember that 2 touches do not equal confirmation. A common mistake is shorting the second peak prematurely, only to be stopped out by a breakout. Wait for that middle pivot to break. Brad's tip: avoid guessing. Let the market prove its intent by failing to hold the level on the second attempt. Triangles function as continuation patterns, formed as price ranges contract. Whether ascending, descending, or symmetrical, they visualize a volatility squeeze. Energy builds toward the apex, leading to a eventual breakout. The crucial advice here: trade the breakout, never the anticipation, and wait for a candle close beyond the line, not just a spike. Flags and pennants are some of the most reliable continuation patterns. They represent orderly profit-taking within a strong, established trend. Think of it as the market catching its breath. If a flag retraces more than 50% of its pole, it's likely a reversal, not a pause. Don't be fooled by costumes. Rising and falling wedges are defined by converging trend lines that slope in the same direction. These often signal a move running out of fuel, leading to a breakout against the slope. They are notoriously easy to mislabel, often confused with simple trend channels, so be strict with your requirements before entering a trade. The cup and handle is a classic accumulation to launch pattern. It features a U-shaped recovery followed by a shallow handle that shakes out weak hands. Avoid sharp V-shaped bottoms. The patience required for a rounded base is what gives the pattern its edge. When the breakout hits the rim, look for volume to confirm the follow-through. Rectangles and rounding bottoms are slower, base-building structures. A rectangle shows price trapped between horizontal support and resistance, while a rounding bottom is a gradual shift from bearish to bullish. These patterns punish those who demand a trend when the market is clearly still in the box. Trade the edges or step aside. The time frame trap is a vital lesson. The same pattern on a 1-minute chart means something entirely different than on a monthly chart. The 1-minute pattern is a scalp susceptible to noise, while the monthly pattern reflects massive capital positioning. Match your pattern time frame to your holding period. Otherwise, you're looking at the wrong chart entirely. If you are pattern hunting on a 15-second chart, you aren't finding structural strength. You are watching static. Jumping from a short to a long, because a 15-second squiggle change shape is a recipe for losing your account. Real trading uses higher timeframe bias to guide entry timing on lower timeframes, not the other way around. Moving into candlestick patterns, we look at the individual bar. These are centuries-old tools that whisper who won the last fight. Always remember, candlestick patterns are context-dependent. A beautiful hammer candle at a random spot is just a bar. A hammer at a tested level is a signal. The doji signifies perfect indecision, where the open and close are nearly identical. It shows that neither side won the battle. At the end of a trend, a doji is a warning that momentum is stalling. However, if it's appearing in the middle of nowhere, ignore it. Location is the only thing that turns a doji into a signal. Hammers and hanging men share the same visual structure, a long lower wick and small upper body. It's all about location. At a bottom, it's a bullish hammer, showing a successful rejection of the lows. After a rally, it's a bearish hanging man. Never trade the shape without reading the context of the overall trend. Engulfing patterns are powerful two-bar reversals. A strong candle body swallows the prior one, signaling a decisive shift in control. They are most potent when they appear at key support or resistance levels. Without that level, an engulfing bar is just a larger-than-average candle. Don't let a big bar convince you of a reversal that isn't supported by structure. Morning and evening stars involve 3 bars: an impulse, a small-bodied pause, and a strong reversal bar. The middle bar acts as a hinge, signaling the end of one trend and the birth of another. The third bar is your confirmation. It must close strongly to signal the pattern is active. No pause, no star. Finally, the 3 methods pattern, rising or falling, is the trend's breather. A big impulse bar is followed by a small-bodied consolidation, then another big impulse. If those small bars break outside the range of the initial big bar, the trend has lost its grip. Watch the range, keep your discipline, and let the pattern confirm itself. A marubozu is a full-bodied candle with almost no wick, signaling total one-sided conviction. In contrast, a spinning top is a small body with long wicks, indicating a fair fight with no clear winner. These 2 candles bracket the entire conviction spectrum. A marubozu confirms the force behind a move, while a spinning top warns that force is fading. By observing these, you can gauge shifts in market sentiment before they manifest in broader trends. Use a marubozu to lean into a breakout. Conversely, treat clusters of spinning tops as a heads-up that a trend is losing its grip. Remember, one spinning top is just noise, but a cluster after a strong run means the easy part is likely over. A candle without context is just a rectangle. Every candlestick pattern shares a single truth. The bar means nothing until you know where it printed. A hammer floating mid-range tells you nothing. The same bar at tested support is a signal. Before you name a candle, check 2 things. Location, is it at a level? And trend, is it exhausting? Confirm with the next bar, and remember that time frame scales the significance. A daily engulfing outranks a 1-minute one by miles. Confluence is the whole point. Any single tool is a coin flip with extra steps. By stacking independent tools that agree on a price or outcome, you finally gain an edge. Confluence occurs when several unrelated methods point to the same conclusion. It's the difference between one witness and a courtroom full of them. Independence is key. 5 momentum oscillators agreeing isn't confluence, as they measure the same thing. Confluence raises probability, not certainty. It stacks the odds in your favor, but never removes risk. Size your trades accordingly. Remember that quality beats quantity. 3 strong independent signals are better than 15 redundant ones. Confluence is a filter, not a trigger. It tells you where to pay attention, but you still need price action at that zone to provide the actual entry. Let the confluence guide your focus, not your trigger finger. A plus level confluence occurs when geometry, fair value, and auction mechanics align across multiple timeframes. For example, a Fibonacci golden pocket overlapping with an anchored VWAP and a high volume point of control provides a clear, high probability zone. Most trades are not A-plus setups, and that is by design. This designation is reserved so you can size up with confidence when the confluence of trend, level, volume, and clear invalidation finally appears. The most powerful confluence is between timeframes. When the daily, hourly, and 5-minute charts all tell the same story, you aren't predicting, you are following the current. Follow a repeatable top-down workflow. Set your bias on higher timeframes, identify key confluence zones on the mid-timeframe, and wait for a clean trigger on your entry timeframe. When timeframes disagree, stand down. Avoid the trap of analysis paralysis. While confluence is vital, Don't let the hunt for the perfect setup keep you from taking good ones. 2 or 3 strong, independent confirmations are usually enough to act. Beware the Christmas tree chart. When you add too many indicators, you stop seeing the actual price action. Ruthlessly curate your tools. A clean chart leads to a clearer mind, helping you focus on the price, not the indicators. Stop fooling yourself with bad backtesting. Real backtesting is boring but essential. Focus on large sample sizes, testing across market regimes, accounting for all costs, and validating your rules out of sample. Define your rules before you test and forward test on a small scale to find flaws your spreadsheet might miss. Don't fall for the sample size of one fallacy. Judging a strategy or an indicator after a single trade is just gambling. A real edge requires a large sample size. A single result is just noise, not validation. Learn from the distribution, not the anecdote. True edge is found in risk management, specifically through R multiples. Define your 1R risk clearly. Target rewards of 2R or more. Keep per trade exposure under 1%, and always focus on surviving to take the next trade. Great risk management beats a great indicator every single time. Trading is about probabilities, not certainties. Accept that losses are a normal part of the process. Think in the long run to see your edge play out over many trades. Detach yourself from individual outcomes and focus on the quality of your decision-making process instead. Always prioritize process over outcome. A winning trade can still be a bad decision if you broke your rules. Reward the behavior of following your plan, not just the profit. Repeatability is the goal that turns trading from a gamble into a profession. Your journal is the most important proprietary tool you have. Log your setups, capture your thoughts, and screenshot your charts at entry. Review your data weekly, tag your wins and losses, and use that information to cut your worst performing setups. Success comes down to the trader, not the tool. Indicators are public commodities. Execution is your true edge. Focus on disciplined behavior and preparation. When you do the hard work of building a process, your indicators will finally earn their keep. Use these cheat sheets to keep your trading arsenal, your rules, and your priorities in focus at a glance. They are designed to be quick references for your daily workflow. Here is the first part of our master reference. This list covers key tools for trend, volume, and volatility, showing you their purpose and how they help you confirm price action, rather than replace it. This second part of the reference focuses on momentum, Fibonacci tools, and structural concepts. Remember, confluence from independent families is what you want. Don't simply repeat the same opinion by stacking identical indicators. Understand that the same tool can mean different things on different time frames. Always match your tools to your specific holding period. A signal that works for a scalper may be noise for a position trader. Before you take any trade, run this pre-trade confluence checklist. Do you have a clear bias, a confirmed trigger, and risk-defined trade? If you can't tick these off, it's not a trade, it's just a feeling. Follow these don't be Brad commandments. Respect your sample size, honor your time frame, manage your risk, and wait for confirmation. These rules are your defense against bad habits. In summary, remember these 4 pillars. Maintain a consistent framework, respect your time frames, look for genuine confluence, and always keep risk management as your top priority to stay in the game. Remember, the indicator is never the edge. You are. Stay disciplined, keep your framework, and always prioritize your own growth as a trader.